S&P 500 index funds are a great method to acquire diversified exposure to the U.S. stock market's heartland. These passively managed funds invest in large-cap equities, which account for around 80% of the entire value of the U.S. equity market. There are many index funds that follow the S&P 500, but these three have ultra-low cost ratios, which means more of your money stays in the fund and earns you higher returns. Furthermore, all three funds closely match or outperform their benchmark index's historical performance. Before we get into the video, allow us to mention that nothing mentioned in this video is financial advice, and we are not financial advisors. We would recommend you ensure that you conduct a due diligence process before making any decision that may affect your financial portfolio. If you are looking forward to seeking external advice, head out to your trusted financial advisor, who has a clear idea of your financial situation. Having said that, let us get into this video. Fidelity 500 Index Fund, FXAIX. The S&P 500 Index Fund from Fidelity is the least priced on our list, with a yearly expense ratio of only 0.015%. FXAIX has beaten its benchmark index in the past, and it pays a 1.3% dividend yield, which is quite competitive. The Fidelity 500 Index Fund should appeal to anybody searching for a single core holding, and it does not have a minimum investment requirement for any account type. However, the fund's performance history is quite short, which may dissuade some investors who want a fund that has gone through numerous economic cycles. Fund inception date, May 4, 2011. Assets under management, $380 billion. Dividend yield, 1.33%. Schwab S&P 500 Index Fund, SWPPX. The fee ratio of Charles Schwab's S&P 500 Index Fund is just slightly higher than Fidelity's, but it comes with the benefit of more than 2 decades of performance history. This might be a huge positive for investors prepared to spend a little more for a fund with a longer track record, competitive historical returns versus the S&P 500, and a strong 1.57% dividend yield. SWPPX is a great choice for early-stage investors wishing to gain access to large-cap holdings without the hassle of picking individual stocks, thanks to the $0 investment requirement for all account types. Fund inception date, May 19, 1997. Assets under management, $67 billion. Dividend yield, 1.27%. Vanguard 500 Index Fund Admiral Shares, FXAIX. Vanguard is one of the most well-known names in the business, and its S&P 500 Index Fund has outperformed the benchmark index in the past. With a 1.33% dividend yield and a near-zero cost ratio, investors couldn't do much worse than invest in this fund with a 2-decade track record. Even when investing with individual retirement plans, the $3,000 investment minimum might be a barrier for some participants. IRAs. Vanguard's equivalent S&P 500 exchange-traded fund, ETF, VO, is a lower-cost option for those wishing to get into the market. Fund inception date, November 13, 2000. Assets under management, $277 billion. Dividend yield, 1.34%. Methodology. Our research looked at over a dozen index funds that try to replicate the S&P 500. We didn't include actively managed funds, since they have higher cost ratios and don't always produce greater returns or dividend yields. We also left out ETFs, which are addressed in a separate section. We looked at a few crucial aspects while examining S&P 500 index funds. We analyzed each potential fund's performance, expense ratio, and dividend yield using data from Morningstar and fund management organizations. We included funds with very low costs, returns that nearly equaled or surpassed their benchmark index, and decent dividend yields. Furthermore, we prioritized funds with minimal or no minimum investment requirements. What are S&P 500 index funds? The S&P 500 Index measures the performance of the 500 largest public firms in the United States, based on their market capitalization, or the total value of their publicly traded outstanding shares. The S&P 500 is heavily impacted by the success of its largest firms, since it offers corporations proportional weight over the index's performance depending on their market value. The S&P 500 is commonly regarded as the most important benchmark for large-cap stock performance in the United States. If a company's entire market capitalization is $10 billion or more, it is termed a large cap stock. Index funds that follow the S&P 500 hold equities that are included in the index in order to closely match the index's performance. They are passively managed, like other index funds, which means that fund managers just purchase and sell equities to keep the asset allocation of the fund in line with the benchmark. Index funds do not do fund research in order to outperform the market. Instead, they aim to mirror it. How to choose an S&P 500 index fund? Because there are so many S&P 500 index funds on the market, it's critical to keep a few factors in mind when selecting one for your portfolio. Consider the following: the cost-to-income ratio. Expense ratios, which indicate the fees you pay for the upkeep of your fund, should be minimal because index funds are passively managed. Because all S&P 500 index funds perform identically, the amount you spend in fees becomes crucial when choosing a fund. A minimum investment is required. For taxable investment accounts and IRAs, index funds have differing investment minimums. Make sure your choices are compatible with the first investment amount and that you'll be able to buy more shares at regular intervals that fit your budget. Yield on dividends. One of the advantages of investing in large-cap firms is the ability to receive dividends. Dividend yield should be compared amongst index funds, since dividends can help enhance returns even in low markets. The start of the company. Pay attention to the fund's founding date if you're an investor who wants to evaluate a fund's track record before investing. Longer-term funds can show you how an index fund profited during bull markets and minimized losses during downturn markets. Keep in mind that your portfolio just requires one S&P 500 index fund. The top funds have essentially similar returns that are within a few percentage points of one another, so separating assets between two funds isn't worth it. If you can't decide between the two, try putting one in your 401k and the other in an IRA or taxable investment account. What is the difference between index funds and exchange-traded funds, ETFs? S&P 500 index funds and ETFs are functionally equivalent for most individuals, and you should select whichever fund, index or ETF, has the lowest cost and financial minimums that are appropriate for your investing goals. That said, here are a handful of differences to keep in mind. ETFs are more liquid, trading throughout the day like stocks on the exchange. Index funds can only be bought or sold once a day, after all other trading has stopped. This distinction is likely irrelevant if you're a long-term, buy-and-hold investor. ETFs may have lower management costs than index funds that track the same index, but don't assume index funds are always the more expensive alternative. ETF buy-ins are frequently substantially lower than mutual fund minimum investments. However, fewer brokerages enable you to buy fractional shares of ETFs, which may make purchasing further shares more challenging. In an employer-sponsored retirement plan, such as a 401k, you're far more likely to discover exclusively index funds, ETFs offer a somewhat better tax management arrangement, although this is less of a factor to consider for index-based funds that don't trade frequently and funds held in tax-advantaged retirement accounts. Whether you choose an S&P 500 index fund or an ETF, keep in mind that these funds are still a good way to get large-cap stocks into your portfolio without having to vet individual stocks. You'll have lots of alternatives that correspond with your assets, an investing plan thanks to minimal management fees, and a wide range of investment minimums. The video for today has come to an end. Thank you for stopping by to watch. Please consider giving this video a thumbs up and subscribing to the channel if you enjoyed it. Make sure the bell notification is turned on so you don't miss any new information from us. Also, don't forget to share your investing opinions. In our next one, we'll see you all again. Until then, bye.